So it's really great to be here in Cambridge. I actually did my PhD in Cambridge, finished up a couple years ago, so great to be back. And thank you very much to the organizers for putting our paper on the program. This is joint work with Sinem, Helen, Adrian, Vanya, and Jenny. Of course, the usual disclaimer applies. These are just our views and not those of any of our institutions. So in this paper, we're going to be looking at currency risk-taking and risk management by financial and non-financial firms. And to do this, we're going to turn to FX derivatives markets, where now 70% of global FX turnover takes place, compared to only 30% in spot markets. So this makes this market, in our view, a key market to understand how exchange rates are determined, how firms are taking financial flows, trade flows, and also understanding policy spillovers across the world. But historically, granular data on FX derivatives positions has not been readily available. So that's where we're going to come in this paper. We're going to exploit over 100 million transactions to construct and analyze daily firm-level net exposures for all 16,000 firms in the largest FX market in the world, which is in the UK and London, which is about 40% of the global FX derivatives turnover. And with this data, we're going to try to answer some key questions. The first is, what do the net exposures of the entire market look like? Thinking about all the different players, asset managers, banks, non-bank market makers, hedge funds, and non-financials. Within that, we're mostly going to be interested in who is mostly using this market to hedge, who is mostly using this market to speculate, and who is providing the liquidity. We'll also be interested in how concentrated is the market, and within the sector, how much heterogeneity is there. Second, we're going to ask, how do each of the sectors adjust their net exposures to changes in macroeconomic news, changes in interest rates, or changes in CIP deviations? And what we're interested in here is who is speculating on the margin, and how is the market clearing in the face of this speculation? And finally, we're going to investigate conditional and unconditional co-movement between these net exposures and exchange rates. And in terms of conditional co-movement, what we have in mind is which sectors appear to be adjusting their exposures in a manner consistent with the propagation of various aggregate shocks to exchange rates. So the shocks we'll be looking at are, of course, monetary policy and a measure of risk, credit risk, which we're going to construct from macro news surprises. Let me just jump into our data. So we're going to be using the UK segment of the EMIR Trade Repository dataset on over-the-counter FX derivatives transactions. This is going to cover all FX derivatives, in our case, namely swaps, forwards, and futures, that have either a UK firm as a counterparty or an EU firm as a counterparty, provided the transaction takes place in the UK or includes the pound. We're going to clean this data. We're going to see these transactions second by second. And we're going to arrive at about 100 million clean transactions over our sample. And from these, we're going to construct our net exposures. I should say our sample runs from the 1st of January 2015 to December 31st, 2020. The reason why we cut our sample in 2020 is because we use both the EU reporting and the UK reporting firms in our data set. And starting in 2020, when Brexit officially kicks in, we cease to see the reporting of EU firms. So that affects some data coverage. Despite that, you're going to see in some plots at some points, you're even going to preemptively see the departure of some euro trading in this market as well. And we're going to classify firms into sectors. Just one slide on the data cleaning. So this data cleaning took a long time, and it's really important to clean it. We noticed that according to the principles of reporting, around 40% of the reported forward rates were flipped. So we had to develop some algorithms to flip them back, essentially. OK, so in terms of the firms in this market, the vast majority of them, like 75%, are asset managers. And within that, about 90% are investment funds. That's because we view this data at the fund level. The second most common firm in the market are non-financial corporations, about a quarter. Hedge funds are a relatively small fraction of individual firms in this market, only 3%. But we're going to highlight, hopefully, convince you guys that they play a really important role in this market. Among the banks, the 335 banks that we identify in the market, there are about 20 dealers that are on one side of almost all the transactions in this market. OK, so let me turn to the net exposures. So you might ask, why does a firm trade in FX derivatives? Maybe you guys aren't asking, but just for for completeness here. So we've developed like a simple partial equilibrium model to understand the motives behind firms' FX derivative trading. So we're going to consider a UK firm I that chooses its net exposure in the US dollar GBP currency cross, denoted here by N, by solving a mean variance portfolio choice problem over its total profits. These profits are composed of a non-derivatives term, X, which the firm takes as given when it makes its FX derivative choice, but which might load on the exchange rate. And then their derivatives profit given by pi. So their profit from trading a derivative is given by this expression here. So for example, if that UK firm is net long the dollar via, say, a forward, so they're going to receive dollars in the future and pay pounds, that transaction is profitable if the dollar appreciates against the pound in the future spot market relative to a forward rate that is signed at time t. If you solve this problem, you arrive at the following expression for firms' optimal US dollar GBP derivatives exposure, and it's going to be composed of two terms. A hedging component, whose sign is governed by the covariance between the future spot exchange rate and their non-derivatives profits, and a speculative component, whose sign is governed by their future expectations for exchange rates. And in this simple setup, the relative size of these two components is tied to the risk aversion of the firm, rho. So more risk-averse firms tend to have higher hedging components compared to less risk-averse ones. So it's useful just to drill in on this covariance term, this hedging component. So to be concrete, if the UK firm, for example, is a UK investment fund that's holding some US dollar denominated fixed income assets, then the pound value of those fixed income assets increases as the dollar appreciates against the pound. So that covariance term is positive. So the hedging component would push that UK investment fund to go net short the dollar via FX derivatives, lock in a forward rate in which they sell some dollars in the future at a fixed exchange rate, hedging some of that currency risk. So from this simple model, we point out a key distinction between hedging demand and speculative demand, which is that hedging demand is often persistently one-directional. And that comes from persistence in this covariance term. So thinking about that UK investment fund that's holding US dollar fixed income assets, if it's holding that US dollar fixed income today, it's likely to be holding it tomorrow and into the future. So the sign of that covariance term is not going to be changing frequently over time. But speculative demand, firms' expectations about future exchange rates might very well be changing frequently over time. Changes in interest rates, market developments, macro news surprises all change your expectations about future exchange rates, which is going to show up as changing sign in this expectation. So what we highlight is basically that you can look to the sign and the persistence of firms' net exposures to provide a window into whether firms are using FX derivatives mostly to speculate or mostly to hedge, even without relying on information on their underlying portfolios, which we're not going to see for all these different firms that we have in our data set. Just to operationalize this, we need to move from those ends, those transaction level exposures, to firm level exposures. So we're going to construct the net currency cross derivatives exposure, the stock exposure to a currency cross MK by netting out all transaction level exposures from all non-expired contracts at a given point in time. Okay, so that's going to be this variable stock in the MK currency cross, and that's going to be like the key variable that we're going to be studying in this paper, essentially. We'll also be looking not at a currency cross stock exposure, but also a currency stock exposure, and that's going to be netting out for a generic currency L all the cross exposures in which the firm receives currency L and pays currency L across all the different crosses. The reason to study that is that if a firm is trading between two non-US dollar currencies, it often transacts through the dollar. And if you were to look at the currency cross exposure alone, you might conclude that that firm is taking currency exposure vis-a-vis the dollar. But this object here, the currency exposure, is not going to be subject to that issue. And finally, we'll aggregate up within firms in a sector to derive sector level exposures. Okay, so here are the net US dollar, euro, and GBP exposures of the largest client sectors in our 6-year sample. There's a lot of things going on in these figures. We talk about a lot of facts. For example, you can see like this sudden drop in the pension funds exposure vis-a-vis the euro. That coincides actually with, that's an extensive margin effect. We see the departure of some large EU pension funds from our sample over this period. They may have moved their trading to the EU, for example. But the thing I want to focus on is that all four of these sectors maintain persistent net short exposures to the dollar over almost all of our sample. Now, these are sector level exposures, of course. I'm going to show you in a sec the firm level results. But through the lens of our model, this suggests that these firms are using FX derivatives primarily to hedge some dollar currency risk. On the other side, dealer banks are persistently net long the dollar via FX derivatives, seeming to be the primary sector that's accommodating the hedging demand of those large client sectors. These exposures are large, but it's likely that they're offsetting in other markets. So for example, in this market, accommodating hedging demand implies they're net long dollars via derivatives. In the US market, accommodating hedging demand would imply that they're net short. Also, these are largely coming from swaps. But what's different are the hedge fund exposures. So hedge fund exposures to the dollar are changing signs frequently over time. And through the lens of our model, that suggests that these firms might be using FX derivatives mostly to speculate. Another thing to point out here is the size of the exposures. Hedge funds exposures are smaller, much smaller than those of the other client sectors who are using derivatives mostly to hedge. So this market is dominated by hedging agents trading with dealer banks. And hedge funds, in terms of net exposures, are a relatively small share of the market. But they're going to do some interesting stuff, which I'll show you in a second. OK, so one thing I mentioned was that the sector level exposures can obscure whether or not individual firms in a sector are one directional over time. So this plots the share of firms in a given sector that maintain the same sided exposure to the dollar over almost all of our sample, defined as over 95% of the days in our sample. What we find is that on the one extreme, over 60% of individual non-financial corporations maintain that one directional exposure to the dollar over at least, over virtually all of our sample. And then over 30 percentage points lower at the other extreme are hedge funds. So through the lens of our model, this suggests that non-financials, the non-financial sector is composed of the most amount of pure hedgers, for lack of a better word, and the hedge fund sector is composed of the most amount of pure speculators. These other sectors sort of line up in between. Now, this is only one way to distinguish between speculation and hedging, but I think what's interesting and sort of comforting is that if I asked you to maybe sort sectors based on how much you thought they were hedging versus speculating, you might arrive at something that looked a little bit like this. OK. Another thing that we do is we break up the sectors into those that are UK-based entities and EU-based entities. And you see this striking separation. So UK investment funds and pension funds, their net short positions in the dollar are almost all taken against the pound. EU investment funds and pension funds, it's almost all taken against the euro. So the currency in which these firms are evaluating their profits and losses is clearly important to the direction of their trading. And that suggests, again, that they're trying to hedge some risk. You don't see that, though, for hedge funds. You see the dollar exposures and the other exposures are actually positively correlated across these sectors. So as I mentioned, concentration. So this market is actually very concentrated. The largest 5 dealer banks in this market account for a significant share of the entire dealer bank sector's net exposures to the dollar. Insurance companies and pension funds among clients are also highly concentrated. Investment funds at the top there are the least concentrated sector. And they're also a sector that has a fair amount of within-sector heterogeneity in the direction of their exposures. You also see that for non-financial corporations as well. This might reflect differences in their underlying portfolios. So some non-financials might be pricing in dollars, some in euros, some in pounds. Some might be net importers, net exporters, and so on. OK, so now we're going to turn to some more analysis, in particular on how the FX market adjusts. So as I said, the market is composed mostly of hedgers trading with dealers. But we're interested also in speculative behavior, and in particular how the market is adjusting to accommodate speculative demand. So we're going to be interested in how different sectors are adjusting their net exposures on the margin alongside correlates of speculative demand. So we're going to start with the carry trade. So we're going to be running regressions, panel regressions of firms within a sector, changes in their MK stock exposure on changes in the M minus K interest rate differential over the same horizon H. And what we find is that as the M minus K interest differential widens, hedge funds go more long currency M against currency K. So they're performing the carry trade. On the other hand, non-financial corporations are moving in the opposite direction. They go more short currency M as M's interest rate increases. So they appear to be the sector that's on the margin accommodating the speculative behavior of hedge funds. Now you might ask, why are they doing this? Are they being forced to do this? There's a natural, I don't think they're being forced to. There's a natural reason. This could just be due to correlation between their hedging demand and interest rate differentials. So for example, if currency's M's interest rate increases, that could be due to the systematic component of monetary policy. So the economy is doing well in jurisdiction M, and so interest rates are going up. At the same time, good news in that economy implies that maybe non-financial corporations are earning greater sales revenue denominated in that currency, which they could hedge by going net short currency M. So there's a natural way that these two sectors, and in particular speculators and hedgers, could be taking offsetting positions on the margin with each other. And what's interesting, most interesting in my view, is that dealer banks are largely able to remain neutral with respect to this carry trade strategy, seemingly by taking net exposures with both of these different sectors. Okay? See a very similar thing for momentum strategy. So as the appreciation of currency M against currency K grows, hedge funds are going more long currency M against currency K, non-financials in the opposite direction, and dealers are neutral. A similar thing for an exchange rate macro news index. So as macro news appreciates currency M against currency K, hedge funds go more long currency M against currency K, non-financials in the opposite direction, and dealers remain neutral. For the sake of time, let me skip this and turn to the final section where we're going to look at how net exposures, how the role, the relationship between these firms' net exposures and exchange rates. So we're going to start with conditional net exposures, and we're going to be looking at, as I mentioned at the start, which sectors might be propagating aggregate shocks to exchange rates. So we're going to be running IV panel local projections of the H-date change, log change in a currency cross, MK. So this is across currency crosses. The H-date change on the one-day change in sector level net exposures. And we're going to be instrumenting these sector level net exposures with various aggregate shocks. The first aggregate shock that we're going to look at are monetary policy shocks. So we're going to be running this first stage regression, changes in sector level MK net exposures on monetary policy shocks in jurisdiction M and monetary policy shocks in jurisdiction K. In practice, we're going to have 4 currency crosses here: US dollar euro, US dollar pound, euro pound, and dollar yen. And we're going to have 4 different monetary policy surprises: Fed, ECB, Bank of England, and Bank of Japan. And then we're after a sort of the second shock, we're after is essentially a risk-off type of shock. And to do this, we're going to turn to credit risk, and we're going to construct a credit risk macro news index by regressing U.S. credit spread index on macro news surprises. The idea here is that there's this robust association in the data where when U.S. credit spreads rise, the dollar tends to appreciate in a seemingly a flight to safety type behavior. And this is also going to be true for our U.S. credit risk news index. So when news raises U.S. credit spreads, the dollar tends to appreciate. And what we're interested in is which sectors might be propagating this news to the exchange rate. Now, we're going to do this. We're going to run these regressions for all the different sectors, but we're going to focus on the sector for which these shocks are strong instruments. And it's going to turn out to be, for monetary policy shocks, that it's hedge funds, and for credit risk, it's going to be investment funds. So when there's a tightening surprise in jurisdiction M or an easing surprise in jurisdiction K, hedge funds tend to go more long currency M against currency K. And for investment funds, when there's adverse macro news that raises US credit spreads, investment funds tend to go more long the US dollar against the pound and the euro via FX derivatives. Okay. And I should just very quickly mention that this investment fund behavior, that could be just a pure speculative motive, but it could just be that, it's sort of speculation as well, but they could just be unwinding their net short hedging positions in the dollar in response to, greater credit risk, which they might anticipate would appreciate the dollar. So why should they be hedging? And so here are the second stage local projections, and they highlight that, as hedge funds go more long currency M against currency K, conditional on monetary policy shocks, this is associated with an appreciation of currency M against currency K. And similarly, when investment funds go more long the dollar, conditional on credit risk increasing, the dollar tends to appreciate. Now, basically, of course, this is not to say this is the only channel through which this is happening, but if you believe that prices and quantity movements in the FX derivatives market are driving or responsible for some fraction of exchange rate movements, then it could only be these two sectors, in particular hedge funds for monetary policy and investment funds for credit risk, that could be driving the observed exchange rate dynamics that we see. These are the only sectors for which this appears to be the case. One little anecdote with my last minute of time. You might recall, the dollar depreciated a lot in recent weeks and months, and commentary has suggested that this had to do with various sectors hedging more dollar exposures that could have amplified the initial dollar depreciation. This is basically the exact opposite of what we're seeing here. So in this case, risk goes up, risk off shock, investment funds unwind their hedges. And so the fact that they increase their hedges in response to risk off shock on April 2nd suggests that there might be changing correlations there. The final thing that we do is, given that different sectors appear to be propagating different news to exchange rates, we look to see which sectors' positions contain the most information contemporaneously for exchange rate movements. So we're going to run changes, regression of weekly changes in exchange rates on contemporaneously weekly changes in sector-level exposures, including a lag, for all the different client sectors. So we're dropping dealer banks. And clearly, based on this fit, these positions contain a fair amount of information for exchange rates. But it turns out that it's hedge funds positions who load positively on exchange rates and non-financial positions who load negatively that appear to carry the most information for exchange rate movements. Okay, so thanks very much. Basically, in this paper, we tried to document new facts about the inner workings of the largest FX market in the world, trying to understand how different sectors map to the distinct agents in macro models, and hopefully that can be useful for future research. Thanks very much.
All right, so the paper is extremely well written, very polished, and initially I said, okay, what can I say about the paper? There's not much that I can say. In fact, I said, maybe I can sing a Neapolitan song, right? The problem is that I'm completely out of tune. And very likely you're gonna scream before I hit the first note. So I had to decide, to write something. Now let me set the stage. Of course, most of you are aware of what I'm gonna say in the next few slides, but let me try to stress why it's important to read this paper. Now here I got a couple quotes from the FT. So where the FT says, look, we should care about the FX market because it is the backbone of international trade, the global investing. It creates additional demand for goods and services. And without the FX market, there would be no economic growth. However, the FX market is not just about international trade. It's also about investing. In fact, you can use currency. Of course, you can trade spot, derivatives, so on and so forth, to achieve international diversification, and you can also generate some alpha. Now, if you look at the basic statistics that you get from the BIS survey from 1992, what you learn is that there has been an explosion in the daily turnover of FX derivatives. For example, if let me show you the next, for some reason not working the, okay, here, there you go. Now, if you look at the share between derivatives and spot, like in the early 90s it was 50-50, but over time the share of derivatives relative to spot has been increasing substantially. So as of today, well, as of 2022, so derivatives account for about 70% of the global trading activity in the FX market, whereas the spot, they account only for 30%, okay? So, all in all, we know that the FX derivatives instruments are important to the functioning of global financial markets. You know, the usual stuff, important for economic growth, for price stability, for capital flows. And, you know, again, it's the largest market. I was doing some back of the envelope calculation last night, looking at the 2025 survey conducted by the Fed of New York at the Bank of England. And very likely, at the next BIS survey, the FX derivatives market will exceed 6 trillion USD. Okay, so it's a gigantic market. However, despite being large, being important, well, in many respects, it remained a black box. Okay, we know very little about the FX derivatives market, and one of the reasons is because we don't really have access to good quality data. And this is where Daniel and co-authors, they come in and they say, you know what, let's try to learn, okay, a bit more about the derivatives market by zooming into using highly granular data. Okay. Now a quick summary. Daniel did a great job in presenting his paper, but let me try to map my summary into 4 questions. First, what does this paper do? Well, it tries to study a map or a topography of the FX derivatives market. Okay, and ultimately the authors they want to understand how different participants use FX derivatives. Do they use for hedging? Do they use for betting on the future exchange rate market? Now, what are the key ingredients? So they use a massive data set. Once they aggregate everything, they end up with more than 60 million daily net derivative exposure at the firm currency level from EMIR. I should say EU and UK EMIR, but EMIR originated under the European jurisdiction back in 2014. And then they come up with a framework that allows you to disectangle these firms' net exposure into hedging and speculative component, and they use this technical framework just as a guidance for the empirical analysis. So what do we learn? First, who is speculating, who is hedging? Well, you can guess. Hedge funds, they tend to bet. Market makers, they typically offset positions by remaining neutral, whereas everyone else tends to hedge persistently in the market. In terms of market structure, now the dealer segment is highly concentrated. You have the top 5 dealers that they intermediate more than 90% of the total exposure, where there is more heterogeneity within client sectors. And then they also show that hedge fund, they contribute to transmit monetary policy shocks, whereas investment funds, they contribute to the dollar appreciation whenever there is a risk of episodes. And what are the implications? Well, if you're a policymaker, you want to read this paper. Why? Because then you can better evaluate systemic risk. You can understand how shocks, think of credit shocks, policy shocks, they propagate through the FX derivatives market. And then, if you're an investor, and we have some investors in the audience today, well, you can learn that there are some, group of investors that actually can help you to better understand future changes in exchange rates. Okay? So here I would say that this is a really important paper. It's a paper that it's filling a gap in the FX derivatives. Typically here during my discussion, I always have a different type of pictures, but I don't want to embarrass my friends supporting Juventus today. That's why I changed my slides. Okay. Anyway, my immediate reaction is that this is a really nice paper, following Borat. However, I had to add my, my comments. And so these are my 2 cents worth comments. Now, the first comment is that you read the paper. It's a massive paper. It's not easy to navigate the paper between the text and the appendix. It's a kind of matryoshka. You have a paper. You think that you're reading a paper, but actually you end up to another paper, which will bring you to another paper, and then you will finish with another paper. Okay? What do I want to say? That now the range of exercise is impressive. Okay? However, there are too many things at once. Okay? You try to map transaction, identify hedging, speculation, analyze macro shocks, testing predictability. The risk is that the reader doesn't understand what is the main contribution of the paper. Okay? So the risk is that you're going to dilute the main contribution of the paper. I would probably prefer, if I were the referee, but I'm not going to be the referee of this paper, that a more focused approach, like to better sharpen the paper's impact. For example, why don't you match corporate firms, balance sheet with the FX derivatives position? Forget about the decomposition that you have at the beginning of the paper. I would ignore that, mainly because you have an assumption, mean variance preferences. Okay, and then you basically you assume that some investors, they don't care about their risk. So I would, this is how you make the interpretation. I would completely ignore that. Okay, try to be more agnostic, but then try to match the balance sheet, firm's balance sheet with the FX derivatives position, and you can really tell me whether it's an hedging or it's a speculative position. And then you can also try to assess what are the real effect of derivatives usage, okay? Especially when you have some macro and financial shocks. Then, I'm not going to go too much into details. We can talk offline later on. Now, you identify 21 dealer banks. How? You say, there are 21 dealers, within our banks. Full stop. You never tell me how you do that, okay? And then you group clients into 5 categories. You have asset managers, but then into asset managers, you have investment funds, you have pension funds, you have hedge funds. Clearly, they have different trading motives. And the risk is that, so you have to double your empirics, because each time you have to present, these groups, and then you have to present the subgroups, okay? My suggestion is that, for example, this is what I've done in a couple of papers using EMIR data. First, I would identify dealers using, the Euromoney FX survey, which tells you who are the top dealers, in town. Then, you could combine together, for example, pension funds and insurance firms. They are very similar. Dealer banks and market makers. There is no need to split them. Also because market makers in your sample are very tiny. But then I would split hedge funds from asset managers. Okay, for example, this is what I have in one of my paper, where we have the breakdown between dealer-dealer, dealer-client, client-client, and then we split dealer-client into these 5 categories. Okay? So now, this is where we look at forward and swap volume. This is what you do in your paper. But for example, if you look at the option volume, which is another type of derivatives, which you don't cover in your paper, actually, when you do the dealer-client decomposition, you have a different picture, because now you have that hedge funds are the dominant trading group. Now, the commentary is about this chart. They are very interesting, this chart. But then, the first thing that I notice when I look at the asset managers is that you have this sudden, change in the dollar exposure. Now, your argument is that, look, the red line is negative, meaning that these investors, they are short, dollar derivatives because they are long dollar assets, okay? But now, if there is this sudden increase, then how should I interpret? Should I conclude that asset managers have reduced their holdings of dollar assets? And if so, why? However, from the same pictures, you also have the dealer banks. The dealer banks, you have the opposite. There is a decline. So then the question is, okay, it's a supply shock or is it a demand shock? And it's not clear from the papers. Now, for example, it could be that banks, back in 2017, they've started to reduce their supply of derivatives. Why? Because there has been the new leverage ratio rule, which moves from end demand average to daily average. And so because of that, the leverage ratio rule is going to hit your balance sheet on each single day. So this could be a story. But I'd like to see a bit more about the details. You just touched the surface on different topics, but you never tell me more in details. Okay, I would say go more, deep into the cake rather than spanning around. Then you have this exercise on how firm the derivatives position respond to market conditions, and then you run this panel regression. And I was a bit puzzled here. Now you take the change in the exposure, which you scale by this absolute average, right? Now by scaling, you are only affecting the alpha. Now it could be that there is a trend in the numerator, right? And there could also be a trend in Z, because in Z you have the cumulative changes in the interest rate. So if you run a panel regression, and I'm not the best guy to talk to about panel regression, why don't you simply add, some time fixed effect? Forget about the scaling, add some time fixed effect. Also, when you have this confidence interval, since you have overlapping regression, maybe you should bootstrap them, okay? And I would also ask, what if you use predictive regressions rather than contemporaneous regression? And then finally, before I conclude, so you have this exercise where you present this correlation. You say, look, I can use my position to predict exchanges, but you have to be careful here, because these are contemporaneous regression. There is nothing about predictability. So it could be that there is a reverse causality. It could be that there is a shock, hits the market, and that's why market participants, they're going to adjust their position, not the other way around. So it would be nice if you move from an in-sample, yet contemporaneous regression, to an out-of-sample, predictability exercise. So to conclude, this paper has both technical and empirical results. I enjoyed very much reading it. And this is a paper that hopefully is going to make the FX literature great again. Thank you.
Thank you so much for weeding through that whole paper and for the great discussion. I agree with basically all of your points. So we are merging corporates with net exposures. I think basically the way that we saw this paper was to provide that high-level overview of the market. But I totally agree that, and this is not just going to be a one-off exercise. We've got other things planned there. Just briefly on dealers, I think it's buried in the paper, our definition, but I think we're using FCA classified dealers or something like that. Your point about changes in these net exposures at the sector level, what explains these sharp movements. We try to do a decomposition in the paper into extensive versus intensive margin stuff, but I think overall the main conclusion is with this data set, it's really important to take a step back, not only think about sector level stuff, but really think about firm level, because this data is noisy. And so that's why we run these panel regressions to look for common co-movement, common trends in movements within a sector, rather than relying so much on the movement of the largest player. Your point about the leverage ratios is really interesting. I see your point totally about the structure of the panel regressions, and for sure I think the way that I see I totally believe that there could be reverse causality. It's definitely a contemporaneous regression. I'm not trying to claim predictability whatsoever. We are working on some predictive stuff right now. But just the way that I see it is that correlation is in some sense like a prerequisite for these players having some role in exchange rate determination. But it definitely is not proof that that's what's going on. Thanks.
Okay, thank you very much for presenting such an interesting and informative paper. I have a question on the data. So I wonder if you can also construct the P&L, the profit and loss for each institution, track their exposure, and to see who are profitable and who made a loss during the sample period.
Yeah, so we actually have constructed profits and losses by comparing as I mentioned at the start, the spot, the forward rate that they get in the derivatives market, comparing that to the future spot rate at maturity. We have that. We have not really analyzed it in much detail, but that is something that we're planning on doing going forward. But yes.
Very cool paper, very cool data. It's encouraging to hear that you're merging in corporate positions, because exactly to Pasquale's point, it's a bit different from Pasquale. I happen to be a fan of mean variance framework, but if you look at that covariance term, right, I think it's hard to argue that it's always one sign, especially if the underlying position of what you have in that X could be changing over time, right? If I'm thinking about a corporation and I have revenue streams from different currencies, to the extent that revenue stream composition changes over time, what appears as hedging to you might actually be potentially speculative motive, right? So perhaps this categorical classification of hedging versus speculative is not doing enough justice to the wonderful data that you have. One more point on that is, if you look, the one very striking figure that you showed is when hedge funds are doing possibly speculative trading in response to carry, is the corporations that are accommodating it, right? If hedge funds are always doing speculative things, potentially the signs are changing over time as well. And so then the signs of the corporations must also be changing over time. So that does not quite go along with the simple hedging versus speculative classification that the paper so far paints.
Yeah, that's really great points. So I agree with you that the framework is really reduced form and simple and meant to just highlight a key distinction. It's not the only way. Throughout the paper we try to highlight, if you're doing the carry trade, we view that as, for example, suggested that you're a speculator in this market. So it's not the only way in which we're trying to distinguish between speculators and hedgers, but it is one of the ways. And I think sort of the point that we're making is that the mountain of evidence across these different sets of analyses in our paper suggests this. To your point about if hedge funds are changing sign over time, but non-financials are accommodating it, shouldn't their positions be changing sign over time as well? I think the main point is that that's true on the margin, but these non-financials are maintaining a stock of net short positions in the dollar over time, and they're just oscillating around that. That's how I sort of see it. Whereas hedge funds are oscillating around like a zero position, but it's something to think about.
One of the effects that you've looked at momentum, you've looked at carry, the way that this is absorbed by the market. One of the effects is actually a rise in volatility. So that's a big thing. If volatility rises, certainly a lot of hedge funds will reduce their position just because they risk manage their position actively. I don't know if that's something that would be worthwhile, because that's a very strong effect. We see that in the commitment of trader report. Whether you'll see that in the FX market as well.
It would be really cool to run that. Maybe we can discuss how to implement it after, but I think that would be really cool.
Yeah, so in a standard combined majority model, the dealer bank is taking the other side of the inflow from the, let's say, the habitat investors. So in this case, it seems like the dealer bank is doing nothing. Is it because of the regulation, or is it because when you aggregate across different dealer banks, it muted that flow into zero?
Yeah, that's a really good question. So firstly, I would say that Gavek's majority don't make a claim about who the arbitrager is in their specification. I think the jury's a little bit out. I think the way that we see it is, firstly, dealers do have net exposure via swaps. I mean, that doesn't necessarily carry much risk, but the way I see it is, hedge funds are speculating in this market. They're doing things that are known to generate excess returns, like the carry, like momentum, which we've been discussing today. Through the lens of that suggests that they're playing a key role in arbitraging this market. Dealers have an incentive, as we were having a discussion at lunch, dealers also have an incentive to trade as an arbitrager in some sense, even if they remain neutral, right? Because they're thinking about how they can offset their position with someone else, right? So they're still negotiating on price. So I think, because they need to know that there's going to be someone on the other side with whom they can offset their position with hedge funds. So I think there's a lot of SDFs. I think one of the things that we want to highlight in our paper is there's a lot of SDFs that matter for exchange determination, and it's not as simple as saying there's just one segment of the market that is pricing everything.
In addition to derivative exposure, do you have spot exposures as well? And I was thinking for the carry strategy, you could look at spot as well as forward. And with regards to the carry, is the idea that hedge funds can use forwards to essentially exploit carry as opposed to swaps, and can you differentiate that?
Yeah. So we don't see spot in our data set. We see, yeah. So what they would do is they would, at maturity of the contract, they would immediately turn to that spot market and take a profit. So in some sense, the way that we think about it is that hedge funds view all these different markets as substitutable. So they could do the carry in the spot market, they could do the carry in the futures market, they could do the carry in the forward market, and yeah. So I think that's I don't know if that fully answered your question, but we see them as a bit substitutable.
Yeah, I was wondering if, given you have the daily data set of all the trades, if you've looked at sort of month-end effects or rebalancing effects, and if focusing on those times or days can tell you, I don't know, further information about which sectors are doing what in response to, say, US equity moves or something.
So we do not really emphasize much in our paper about month-end stuff or quarter-end stuff. I know there's a lot of papers that have looked at that, so I think that's not something that we've done explicitly. But we run these things daily, so our results are going to be overwhelmingly driven by the average day rather than any month-end or quarter-end or year-end effects.
Okay, thank you very much.